Hi, my name is Z with Optionalitie. I am a professional option trader returning 25 to 50% on my portfolio using options every year. Today we're going to talk about how to trade slow moving markets with great risk reward. In particular, we're going to be looking at a call butterfly structure that I put on last week that I took for great profit. Let's begin. So the markets generally goes through phases of market volatility and then volatility expansion and volatility contraction. So in the last couple of months, we had some amazing volatility, but as any options trader knows, there will be weeks to months where the market will just kind of gently float up. And, it generally comes after a pretty big up move where, you think that there's kind of limited upside because the market is kind of extended. So there's quite a bit of downside risk. But there's no short signals, there's no sell signals, so you don't want to actually go short. So how do you make money in these type of environments? Today we're going to look at some call structures that really help you take advantage of these kinds of environments. So you want something with that that there's going to be limited upside potential, but there is going to be upside. So you want to be positive delta. You don't want to take any downside risk. You don't want any tail risk. And there are no sell signals, so you do not want to go short. So the two structures that we're going to be talking about today are the broken wing butterfly, the call broken wing butterfly, and the call diagonal. The call broken wing butterfly is where it's a four-legged or more option where you are long a closer to the money call option, in this case a 95 strike call, and you are short two or more out of the money calls. In this particular case, we are short 100 strike calls, and then we will buy protective call somewhere out farther than the distance of your long and your short. So in this particular case, we're going to be buying a $110 protective call. Now this structure can have any amount of theta, any amount of delta you want in this particular structure. And that's what makes broken wing butterfly so beautiful, is that the edge that you get in this trade is from constructing how much delta do you actually want on this trade. Where do you want to put this short strike? Knowing how to do that will greatly maximize the profit that you have in this particular trade. The call diagonal is another candidate for trading slow moving upside markets. A call diagonal is where you short in the front month a call contract, and then you long a contract in the back month or in the later duration. The reason why I did not choose to do a call diagonal in this particular example is because I couldn't find a contract in the long way out of in the back expiration that had some kind of event associated with it, either it be a Fed or some kind of earnings or something. What you want is to have your long call really hold its value through time, and the best way to do that is to find some kind of event. There wasn't anything like that in the next couple of weeks, so I didn't want to put the call diagonal. I did do a video on an FOMC trade that uses a call diagonal as opposed to a call butterfly to great effect. So the reason why these two structures are so great is because the call strikes are more out of the money, and you have the belief that the market is only going to slightly go up. So the likelihood of those short calls being in the money or having any value is very low compared to the long calls that you have that are close to the money. You expect volatility to contract, which once again, causes the short strikes to go down in value quite quickly. And lastly, what makes this position more profitable is knowing your delta, managing your delta, and knowing how to scalp and sell premium against your main position. This is how you can kind of let time be on your side and get as much money back from the market as possible. So let's take a look at the actual position on hand. So this is the position that I put on. This is my trade journal. So I bought 12 butterflies with a long strike at 573, the mid strike at 580, and the protective call at 600, which is for all intents and purposes not relevant. I entered this on September 19th. So let's take a look at what was going on that day. So September 19th, the market kind of gapped over the high of the previous day, which was actually kind of a nasty looking candle, but it gapped over that. It gapped over both the previous highs actually. So we are at all-time highs over here, which is obviously extremely bullish. So I wanted to put on a bullish trade, but I also knew that there was this trend channel that we were in, and we were towards the top of this trend channel. So I thought 580 was a pretty good stopping point for the market because of the 80 whole number, and also there was like a trend channel here. So that's the target that I wanted to go with. As soon as I put on the trade, so this is very important, I immediately sold 12 puts at 555. So on this day, I sold for the next day 555 puts, which was all the way down here for 30 cents. And the reason why I did that is because in order for the market to go all the way down to 555, it would have had to fill this giant gap on the gap up, which is very, very unlikely. When you have this massive gap, is very unlikely it's going to get filled. It has to not only fill this gap, but also take back the entire prior day range and break the lows and go to 555, which is just extremely, extremely unlikely. And I thought 30 cents was a great value for those puts, so I'd love to sell them. And boom, right off the bat, I took my debit down from $1.12 per contract to 82 cents per contract. Now, I knew that I was very positive delta at this particular spot. So what I could, on any rallies, I can immediately sell some calls up here to get even more money back. And if you look at what happened on that day, so we had the gap up, I believe is somewhere here on this day right here. So I entered the position as we were breaking high of the day right here. But what happened was the market kind of went up and then went down immediately. So I thought it was going to be a gap and hold as opposed to kind of like a gap and go. So I decided to sell 18 cents. I mean, this was still pretty far out of the money. 577s, and I was totally fine doing this because I had the 573s, which is a lower strike call, and it's in a later expiration. So if the market somehow makes its way to 557, my 553s were going to be worth a ton. This would have really expanded in my favor. So, and that's how within a couple minutes of entering the trade, I took my debit down from $1.12 all the way down to like 62 cents, 64 cents, which is over a 40% drop in the amount of debit I put in this trade. And both of these went out worthless. So at the very beginning, I took my the cost of my trade down to like 50%. Now a couple hours later, the market did end up ripping in my favor, and it decided to just kind of take off 1/4 of my contracts right then and there, 2 hours after entering the position for $200. And the reason why I did this was twofold. One, even after selling 1/4 of my longs, I was still positive delta on the trade, number one. And number two, after doing this, I basically had no risk in the trade whatsoever. All the money that I paid to get into this position, which is like $1,400 or so, I made back all of that with the premium sales and the call sell right here. Now after that, it's important to note that when I put the contract on, so this is on that day, and this is gonna kind of approximate it because I don't have live data here, but at the end of the day, it shows that I have 12 delta per contract on this trade. So I knew I can sell any calls if I feel like the market is not going to move in my favor. I can sell any call that is less than 12 delta and still be positive delta on the trade. So that's what I did. On Monday, on a pop, I sold some 573s for 20 cents. And I just kept on working. Every day I sold a couple of calls. And sometimes I took some profit. Sometimes I, just sold some calls against the calls that I had in the later expiration. And on Thursday, so I sold some calls on Thursday right here, and I just kind of kept on working the position, taking credit out of my position, out of my 573s, until on Wednesday, what had happened was, I was at 571, and what had happened was I even sold even more calls than I sent out to the members the last couple of days in my personal portfolio because I was heavily long SPY going into this. So I rolled up. I got some free puts down here at like 568. I've been just buying put verticals, selling calls, buying put verticals, selling calls every single day. And I worked up a 568 put. And I was basically right snap in the middle of both the put and all these long calls that I had. And basically it was going to be a 50-50 shot of either doubling my money or it just all going to zero if the market decides to not explode in one direction or another. And when given the opportunity, I always kind of take the midway and just kind of take my money, take the trade off, be happy with the overall gain that I had on this trade was $1,152. And you can see by the end of the week, I mean, yes, we went up, we actually gapped up on Thursday. So if I took all my contracts off at the very top on Thursday, yes, I would have made pretty much the same amount of money that I would have made if I just didn't manage the trade at all and just kind of left it on. But by Friday, the market kind of came down, and I would have made a pretty big loss on the trade because I paid $1 to get into this trade. If I got nothing out of it, that would be extremely tragic. But because of the active management of the trade, the scalping against it, the selling premium against it, my primary position, I was able to make $1,100, even though the market didn't exactly move perfectly in my direction. So I hope you like this trade recap. Please like and subscribe, and comment on any other option structure that you want to talk about. And I hope you have the best luck in your trading. Okay, bye.